Introduction to options. What is an option? An option is a contract that gives the owner the right to buy or sell 100 shares of stock at a set price on or before the expiration date. An option can be bought and sold at any time. The price of the option will move in tandem to the stock price. Option traders are not interested in exercising their rights to buy the stock. Most option traders never exercise a contract during their whole trading career. The contract provides the option holder with the right to buy or sell a security or other financial asset by the writer at a previously agreed upon price, the strike price, and within a set amount of expiration. Within a set amount of time or expiration. It does not obligate the holder of the option to do so, however. An option does not represent ownership of anything. It is just a contract that permits the option holder to make a purchase from the writer within preset limits. What gives option their bite is the fact that when the contract is signed, the holder must pay a non-refundable fee or premium to the writer. This is what injects the element of risk. The holder of the option must believe that the future trade of the securities described in the option will be profitable enough to offset the amount of the premium. Where and who trade options? Options are made and traded in securities and futures or commodities marketplaces. Investors in these vehicles can include individuals, institutional investors, and professional traders. The buying and selling of option contracts is conducted via securities, futures, or commodities brokers and can be tracked by the marketplaces in which they trade. In addition, as options are considered to be securities or futures and/or commodities, they are therefore regulated by the Securities and Exchange Commission (SEC) and the Commodity Futures Trading Commission (CFTC). Let's go over the definition of what an option is. An option is a contract between a buyer and a seller that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before the expiration. An option is just a digital piece of paper, and on that piece of paper is always written three things: an expiration date, a strike price, and a price tag. An expiration date is basically when the date that the option expires. The strike price is the price that you can buy or sell the stock depending on whether it's a call or put. The price tag is the premium that an option holder has to pay in order to enter the contract. All options come with a price tag, an expiration, and a strike price. Let's take a look at an example. Let's say that this option has a price tag of $700. Now it's trading at $1,000. What do you have the right to do as the option holder? You have the right to sell it and exit with a $300 profit. So basically what you're doing is buying an option for a particular value and selling it for a higher value. What if the price of the option is now just $500 because the stock movement go against your prediction? You can also sell it for a loss of $200 to minimize your risk. You would only do this, however, if you believe that you are at risk for losing a greater amount if you were to hold on to the option for a longer period of time. How options are priced. The value of stock options is derived or based on the value of underlying shares of common stock. In many cases, this underlying asset consists of equity shares in a publicly traded company. However, other underlying investments can also include securities, stock indices, futures, commodities, ETFs, or foreign currencies. as options derive their value based upon the value of other underlying asset or security. The market price of an option will either move up or down based upon the market performance of the underlying investment vehicle. Option premium. An option's premium is also known as its price. This is essentially the fixed amount that the purchaser of an option contract will pay for the right to enter into the options contract with the writer. The premium is non-refundable and is always retained by the option writer. Regardless of whether the option is a call or a put, the premium that's paid is done so by the first or initial option buyer. It's important to note that an option's premium should not be confused with the option's strike price, as the strike price is the price that an investor would pay for the underlying equity or asset if the option is exercised. Let's go over the definition of call option. Call option is one of the two categories of options. A call contract gives the owner the right to buy 100 shares of stock at a set price on or before the expiration. A call option increases in value as the stock goes higher. Let's say that the stock is trading at $100 per share. If you have a call that gives you the right to buy the stock at $100 per share, does that option have any value? Not really, because you don't need the piece of paper and you can still buy the stock at $100 per share. But let's say that the stock goes up to $120 per share. Now, what do you have the right to do as a buyer of that option? Well, you have the right to buy the stock or call the price down at a strike price of $100, so that option has already increased by $20. Put option. A put option gives the owner the right to sell 100 shares of stock at a set price on or before the expiration date. So with put option, the owner now has the right to sell instead of buy 100 shares of the stock. And everything else is the same except for that one single word there, sell. With call, the owner has the right to buy, and with put, the owner has the right to sell. So the main difference between a call and a put, the call is used when you are being bullish on a specific stock, meaning that you are betting that the stock price will go up in the near future. Whereas with put option, you would use this strategy if you are being bearish, meaning that you are anticipating or you are expecting the price of a stock to go down in value in the near future. What can you do with call and put options? So as an option holder of a call or put, you have three options. Number one is to exercise your right and buy for a call and sell for a put 100 shares of the stock. Number two is to sell the option, hopefully for a higher price. Number three is to hold till expiration. Really, as an option holder, we just want to do the second one, which is selling the option. We don't want to exercise our right because then we are removing the leverage that option provides us with. You don't ever want to exercise your right to own 100 shares of stock because that will only cause you to spend more money in order to buy 100 shares of stock. Sell the option. We want to sell the option for two different reasons. Number one is we want to sell the option because we think that the stock movement is going against us, and we want to minimize our loss by exiting early. The second reason why we would sell the option or exit out of the option trade is because we want to lock in our profit. The third option is to hold our option till expiration, because if we do this, two different things can happen, and those things are: one, either your option can expire in the money. If it does that, then you're gonna end up owning 100 shares of a stock that you don't intend to own, or your option can also expire out of the money, meaning that your options expires worthless and you are gonna lose your initial investment if that happens. So out of these three different options, then the second one, which is selling the option, is what you're gonna wanna do as an option trader. Benefits and risks. As with any other investment, there are both benefits and risks that are associated with trading options. And while the advantages may far outweigh the risk in profitable trades, it is a good idea to be aware of all considerations prior to placing funds into an option trade. The leverage that's associated with trading in options can allow investors to profit in multiples without the need to actually purchase the underlying investment. On the other hand, because of their large amount of leverage, if an investor finds that he or she is on the wrong side of the market, they could encounter a substantial amount of loss. So the third one basically means that with options, there's also the potential of losing your investment. And that could happen when the stock all of a sudden go against your prediction. Option benefits. Options are a unique trading vehicle. There are a number of benefits trading options. Number one, it requires less money out of pocket. You have the opportunity to profit based on the change to an underlying asset's price, yet without the need to purchase the actual asset. Because with stocks, you're gonna be required to invest more money to buy a share of a particular stock. Whereas with options, you don't need that much of an investment to start with. Number two, potential for a higher rate of return. Ability to earn more profit per dollar invested based on leverage. So with options, you have a higher ROI or return on investment because you are using the leverage of options, meaning that if a stock price were to move, if a stock of a particular company were to move, let's say by $5, you would gain more in your option. You own both, and that stock price has gone up by $5. You would have more return on your option than in your stock. Limited amount of risk. With options, you have limited amount of risk because you are not putting that much of an investment up front to begin with. Number four is the ability to make money in multiple directions, down market or up market. So with options, you can make money in an upward or downward market. Whereas with stocks, you only make money if the stock you own increased in value, meaning that it has to go up in order for you to make money, whereas with options, you can make money in multiple ways, up or down. Option disadvantages. There are also some disadvantages to options, although there are not that many. One of the disadvantages is options have limited life. Unlike stocks that can be perpetually traded for decades, options cannot. They typically have a lifespan of just a few months. Second disadvantage is that options depreciate over time. They lose a little bit of value every day because theta or time decay kicks in. And that's something that you're always going to be dealing with when you are trading options. That's it for this video, guys. We're going to talk more about options in the next videos that I'm going to be putting out. So stay tuned for that, and I hope to see you guys again in the next video.